Ladies and gentlemen, thank you for standing by, and welcome to the Poultry Outlook 2012 web seminar presented by WattAgNet.com. During the presentation, all participants will be in a listen-only mode. However, you may submit questions to the speaker at any time today by typing them through the chat feature located to the left of your screen. Questions will be addressed as time allows. As a reminder, today's call is being recorded. We have three distinguished speakers today who will be presenting their outlooks for 2012. Mr. Tim Brusnahan with Richard A. Brock and Associates will be speaking about feed grains. Dr. Paul Aho with Poultry Perspective will be speaking about poultry supply and demand. And Dr. Chris Hurch with Purdue University will be speaking about red meat supply and demand. Our first presenter is Tim Brusnahan. Mr. Brusnahan is Vice President of Consulting and a Principal of Richard A. Brock and Associates Incorporated, a commodity trading advisor and commodity pool operator that provides commodity price forecasting, research analysis, hedging and procurement strategies for farm producers, dairy producers, as well as for end users of hedgeable and non-hedgeable commodities. Richard A. Brock and Associates Incorporated serves as an advisor to the many of the nation's largest farm operations agribusiness firms, financial institutions, and Fortune 500 companies. Tim, I would like to turn over the presentation and the call to you at this time.
Thank you, Gary, and good day to all that has dialed in to wherever that might be. Thank you for this opportunity to present Commodity Outlook and recap last week's USDA crop reports. Brock Associates is roughly a 30-year company. It's not been until the last 4 or 5 years that our commodity experience has been utilized to present the cyclical nature of agriculture commodities relative to all the risk exposure that now exists in a lot of agribusinesses. Last week's USDA report was a prime example that challenges both farm producers and users of feed grains as well as the poultry sector or protein sector for key feed ingredients of corn, wheat, and oilseeds. It's also challenged procurement departments, top management, their lenders, and customers as well. Before beginning my presentation, I just want to make a comment that in a macro sense, the markets that we follow are really in a big state of adjustment after the significant new demand for the use of corn from the U.S. ethanol industry, while supply has just not been able to adjust to that demand. That's basically where we are today and what we're going to talk about in my part of Feed Grain Outlook. The tight supplies still do generally remain for corn, with the USDA last week projecting roughly a 20-day supply of corn. Quickly, the last week's report went down, and just a real quick, the initial reaction was negative for corn, soybeans, and wheat. On Friday, we were limit down, or last Thursday, we were limit down in corn, which is the 40 cents permissible limit. Nearly all USDA estimates exceeded what the pre-trade averages were. 2011 corn reacted the most, opening and closing limit down. The quarterly corn use was down 6.3% for the September through November first quarter of the 2011 marketing year. Higher yields came in from 3 states. Also, in soybean stocks, we're up just slightly. In winter wheat, we got our first planting estimate for the 2012 year in winter wheat. More specifically, the reports are shown on my slide 4 and 5 that kind of can summarize some of last week's reports. I want to talk a little bit about money flow. Money flow is kind of a new element to the commodity world, but nevertheless, I want to give it some coverage here this morning. Basically, money flow and commodity speculation developed after the post-tech bubble of 2000. There was past attempts for Wall Street and the equity industry to advance into commodities, once in the mid-'80s, another time in the early '90s, another time in the mid to late '90s. All three were unsuccessful, but the tech bubble of 2000 motivated Wall Street to give commodity speculation and commodities in general an asset class, or become an asset class, which led to the boom in alternative investments and a great deal of money flowing into the commodity world. The 2008 meltdown very much scorched the hedge fund industry. That's why the amount of money in hedge funds declined from 2007 to 2008, and since then has stabilized, and some better asset management has developed since 2008. On a personal level, many of these funds that are often written about in either financial publications or other just now better manage themselves and don't seem to be as motivated to pyramid a certain commodity. In other words, at this point, when a market does finally swing, there's not a major position that the fund or manager has to liquidate. And that was the problem in 2008. Once the market turned and rolled over, everybody couldn't get out at the same time. More specifically, corn is a commodity that we follow obviously very closely, and the most transparent way to do so is through the Commodity Futures Trading Commission's Commitment of Traders report. On a weekly basis, they disclose the number of contracts that the large speculator is long the market. Basically, you can see in my slide 8 that the large speculator has been long corn for 309 weeks out of the last 312, or since January of 2006. The significance, and to give the large speculators some relevance, the numbers at the bottom, let's look at 2011 in the far right. The annual correlation, which is defined as the price relative to the percent of large speculators' open interest relative to total open interest. For the annual correlation, it's 0.62. In the first half of 2011, it was a negative correlation, primarily because we went through 4 or 5 opposite USDA fundamental reports that would challenge the large speculator, and we saw the volatility both in price and the level of open interest that the large speculator carried in the first part of the year. However, in the last part of the year, from late August to November, actually the correlation has elevated significantly as the open interest by the large speculator declined. At the same time, the price declined for corn. Now here, since recently, the large speculator has added to their long position, so you can see that the large speculator still has a fairly large 200,000 long position of contracts, which is on the left side. We also follow soybean meal quite closely. The large speculator here, in looking at our past data, has basically been wrong in the grain stocks report. They were right this past week, though, and we define wrong as reducing their position following the grain stocks report or the outcome of the grain stocks report. So in this case, the large speculator is actually short soybean meal versus long, but as the market over the last 6 weeks or so, the large speculator has actually reduced some of their short position in soybean meal. I want to switch gears and talk about supply and demand and the balance sheet for corn. Basically, the message that we want to get across to everyone is that stable supplies somewhat exist now for corn. The feed buyer, both domestically and abroad, more than likely doesn't face the price spikes risk that we may have seen over the last couple of years. Although we don't have a large carryover at 846 million bushels, it's enough that should help stabilize or prevent the $8 price spikes. But then at the same time, we're probably not going to see low $5 corn for the balance of this marketing year. Last week we did see the market come down substantially, but then overnight, this past night, corn's rebounded along with soybeans. The other issue is really planted acreage for 2012. This is a corn supply and demand balance sheet, and on the far right is our estimate for the 2012 crop year. Right now we're anticipating a 94.5 million acre planted crop. That most likely could be on the high side nationally. As of today, it's literally just a forecast. Spring weather and conditions in April and May will certainly determine the outcome of what the U.S. corn plantings will be. The big issue here is the yield. Right now we're looking at a trendline yield of 161 bushels per acre. That would all of a sudden help improve the supply situation and get us up to a very surplus 2 billion bushel carryover for this time next year. Corn yield-wise, really the key issue is Illinois. Illinois is the one state that suffered and has not been able to match its trendline yield history. We put in there the last 8 years. In the last 2 years for Central Illinois has come up with just 157 bushels, well below its trendline yield. Illinois is really the key state, and if Illinois did get favorable weather this next year, more than likely we could see an easy 400 million extra bushels just come from Central Illinois if they were able to get back to their normal trendline yields of, let's say, 165 or even 170 bushels an acre. In last week's report, the grain stocks came in at 9.6 billion, a little less than last year. The feed use was a little bit lower, and that's what also surprised the market last week. Relative to demand, and something that the market doesn't always see closely enough, but if you take out the ethanol portion of the U.S. industrial use, actually demand has been fairly stable. In 2008, it suffered significantly, basically due to the U.S. recession and the loss of demand for paper, and you have to have starch to make paper. So really the demand decline in 2008 was really the demand decline in starch. However, the market has bounced back, and really the key here is that the high-priced corn has actually been able to be passed on to the user, so demand is fairly constant. This has put a lot of pressure on the feed side of the industry, where a tremendous amount of supply rationing has then been shifted, because not everyone in the feed industry is able to pass on the higher price of corn. I want to talk just a second about distillers grain. Production has ramped up just along with U.S. ethanol production. The key now at this point is some of the plants around the U.S. have been producing ethanol consistently every day for several years. Some of these plants are going to start to go through seasonal maintenance. We've seen the last 2 years where seasonal decline in production has occurred. So as a feed buyer, we're going to have to watch the seasonal maintenance cycle, and certainly that will have an impact on price. We also export some corn or some DDG to China, but there's really nothing linear here to give us an ability to determine what stable demand we can have from China. Basically, DDG is a commodity that as we produce it, we've got to get rid of it. We're not going to be able to store this commodity, but it's also we're in the discovery phase of a new feed product that at this time it's very difficult to determine exactly where all the DDG goes. For an example, this past September, October, early November, price of DDG actually exceeded the price of corn. So the price of DDG did price itself out of a lot of feed rations. Ethanol producers in 2012 are planning to remove the corn oil, thus reducing the level of fat and energy in a ration that uses DDG. As a consequence, right now there's different opinions. Some say that the value of DDG will adjust to a lower level. Others believe that the demand might actually increase, which is potentially true for some livestock sectors, but not necessarily all livestock sectors. Can't hardly talk about corn or feed grain outlook without talking about ethanol. And certainly in the U.S., there's nearly 200 ethanol plants making ethanol. It's had a big impact on a lot of things. It's actually displaced feed as the #1 user of U.S. corn. That occurred in a USDA forecast in July. And at this point, the higher demand for corn has elevated, for example, Central Illinois corn basis, which roughly is close to 20-some cents better than the 3-year average, a little better than last year. The takeaway from this slide that we want to make sure everyone understands is that basis is probably going to be compressed versus last year because we do have an adequate, but not big, but not extremely tight either, supply of corn. So basis shouldn't be as weak as last year, but it shouldn't be as strong as what we saw late last summer when corn basis in some areas of the country peaked out at $1.50 over the Chicago Board of Trade values. We follow ethanol capacity relative to each state's corn production. So wherever ethanol is produced, we want to kind of keep track of how much corn in that state is utilized just for ethanol. In Iowa, for example, in years past, Iowa tended to be the residual supplier of other states that had a crop supply decline. That is no longer true now. Basically, 50% of Iowa's corn goes to ethanol. The rest of it is retained for other feed use. Illinois is now the new residual supplier that has the most corn supplies available relative to ethanol capacity. The issue here is that some ethanol plants are such large users of corn, they cannot depend on the local market alone. They have to rail corn in from maybe another area. So this chart actually gives us a great deal of information in working with our clients and determining what the true cost of corn might be. Ethanol margins do remain favorable, as we see in this forward-looking margin outlook. We have modified our margin calculations. We actually use unleaded gas futures versus ethanol futures. It appears that the ethanol futures contract is losing some of its open interest. So at this point, we're following a strict model that was developed by Iowa State. But nevertheless, we're kind of using regular gas futures as our other component to determine ethanol margins. On the world supply, the laws of economics remain intact as we saw increased world production this past year as the world responded to higher prices. So we did see a nice crop from the Ukraine as well as China develop. Not such a great crop here in the U.S. in some areas with the extreme heat in Texas and Missouri that we had through all the way through July. Nevertheless, even though we've seen an uptick in supply, our use of corn has followed right behind it. So we have not been able to improve our ending supplies in the world market for corn. Let's talk about soybeans real quick. Soybeans will have to compete with corn this next year. In some areas of the country, part of the problems that we believe Central Illinois has had is continuous corn. There could be, but it's difficult to forecast, maybe some added soybean acres for some levels of certain farms, but that's not typically going to be the case in all cases. There will still be continuous corn in several areas of the prime corn-growing states. So as we forecast the soybeans for this next year, 2012, we believe we should see somewhere in the neighborhood of 74.5 million acres with a trendline yield of 44 bushels per acre. That should give us just shy of 400 million bushel soybean carryover. What this does is basically gives us the first double-digit stocks-to-usage ratio of 12.5% since 2006. The market is a little more accustomed to a single-digit stocks-to-usage ratio for soybeans than it is for corn. Soybeans is a fairly efficient commodity. If you go back a long time into history, basically soybeans is a commodity that we use whatever we produce. One thing that has shifted just a little bit here in the last couple of months, and that basically is the soybean crush. Not only have we seen a little bit of demand come back to soybean meal, we've also seen the industry operate at a slight reduction of full capacity. So in other words, we have seen the crush value slightly improve just over the last few weeks. I'm going to close out today with just a summary of each commodity, starting at the top. Money flow, certainly on corn side and soybeans and hogs and milk. The large speculator remains long the market. He's short, however, on wheat and soybean meal. U.S. corn market, it seems to have found, at least for the old crop values, which would be the March, May, and July futures on the Chicago Board of Trade, somewhat of an equilibrium or balance, which was one of the few times that we have seen this over the last 6 years, starting back in 2006 when ethanol demand ramped up. This is all good news for feed buyers, and like I said, based on these kind of supply estimates, we shouldn't see any significant price spikes like we've seen the last few years, as long as we don't run into some weather problems next spring or summer. Ethanol margins all look on the positive side. DDG next year will be a transitional year as dry millers of the ethanol modify their production to create a new feed product. On the world side, even though supplies have increased, stocks remain fairly tight or the same year over year. And on soybeans, the poor crush margins kind of given that market some weakness, but we have seen some nice improvement, and now it seems like the South American weather is kind of the short-term driver. In the overnight markets, soybeans generally close 15 to close to 20 higher, so we should see some strength when the markets open here in about an hour. Gary, that concludes my portion. I'll turn it back to you.
Thank you very much, Tim. That's great information. And just a reminder for our audience, we will have questions for our presenters after the conclusion of all three presentations. So we already have some for Tim in the queue. So remember to use the chat box at the left of your screen to offer questions for our presenters. Tim, thank you very much. Our next presenter is Dr. Christopher Aho. Professor Hurch joined the Purdue University Department of Agricultural Economics in 1981. Okay, I see we have a change in the schedule. We had originally planned for Dr. Hurch to be next, but Dr. Aho is queued up, so we'll move to his bio. Thank you for letting me know that. Dr. Paul Aho will be talking about the Poultry Outlook for 2012. Dr. Aho is a native of Connecticut. He's an international agribusiness economist specializing in projects related to the poultry industry. but working in other areas as well, including aquaculture. His work experience includes academic positions in the poultry departments at Cornell University and the University of Georgia, and agribusiness experience at two of the world's largest poultry breeding companies. Dr. Aho writes the bi-monthly column Poultry Perspective in What Poultry USA. He operates his own consulting company, Poultry Perspective, through which he has worked with agribusiness managers and government policymakers around the world. Paul, would you please take our conference now, please?
Thank you very much, Gary, and good morning to everyone who has joined us today. I'm going to be talking primarily about chicken supply and demand, and I'll say a few words about turkeys as well. What we've seen lately is a very unusual drop in chicken demand after decades of rapidly increasing per capita consumption of chicken in the United States. We had this unusual drop in the last few years in chicken demand, primarily due to higher input prices, the grain that was just discussed. The recession, of course, played an important role. There was more decline in food service, the restaurant part, than retail. And, of course, we lost the Russian market in the last few years. So we have this unusual decline in per capita consumption that's gone from nearly 87 pounds per capita down to a projected 79 pounds this year. This is a temporary decline, very unusual, very noteworthy, but I think we're reaching the bottom of that decline this year. Of course, input prices were important in fueling this decline in consumption. Corn prices are triple what they were a few years ago. That has had a big impact on the cost of production. We've had the worst recession since World War II. This is a graph showing the job losses in all the post-World War II recessions. You can see that most recessions we get a steep V down and a V back, and this time we had a steep decline and a very shallow return. So this has affected all meat consumption, including chicken. Another thing that's happened is that the median household income has declined during the recession and declined even after the recession, and by some measures is still declining. So all of these things, here's the restaurants. In 2009, a severe contraction in the restaurant that affected the food service part of the equation. Even in 2011, we had a little bit of a dip in restaurant performance. Now it looks as though it's coming back. And of course, the final piece of the demand puzzle is the sudden decrease in exports to Russia. Now, when we look on the supply side of chickens, you can see that in 2009, the domestic supply of chickens dropped 3.7%, which was logical right at the bottom of that recession. But then, unfortunately, the chicken industry started increasing in 2010 and 11, an ill-advised increase in production when demand was dropping. And this led to severe losses in the industry and several bankruptcies last year. 2012, it looks as though supply will be down. Finally, supply and demand will start coming back into balance this year. We can see from the eggs set at the end of last year that we certainly are in the process of adjusting supply down to demand. If we zero in on the first and second quarters of 2012, you can see on this graph where the per capita domestic disappearance, that's what's going to be eaten in the U.S., is down by a couple pounds per capita. That's a huge decrease for the first and second quarters of this year. By the end of this year, we will probably start to once again increase consumption in the U.S. As a result of these lower supplies, we're getting higher prices, of course, and higher leg quarter prices. The recession has helped increase the demand for leg quarters in the U.S., being a lower priced meat. And of course, the lower supply has helped increase the price. And export demand is finally improving. There are countries that are replacing Russia for our exports. So here's that large leg quarter supply. This is the amount of leg quarters supplied to the domestic U.S. market, which has been going down significantly from 2006, precisely during the time when Americans are rediscovering leg quarters, deboned thigh meat, and it's becoming more popular in the United States. So as a result of this improving demand and reduced supply, the leg quarter price, which was below 30 cents a pound in 2006, is now up over 50 cents a pound. So a significant increase in the leg quarter price from extremely low price in 2006 to a higher price now. If we jump over to the deboned breast meat price, of course this is the product that the industry lives or dies on. Lately they've been dying. Production will be flat or declining this year. Competing meats will be rising, and there should be some economic rebound. So I think we can look forward, at least if you're a producer of chicken, you can look forward to increasing deboned breast meat prices this year. So we had a period of declining deboned breast meat prices that reached bottom in 2011 at highly unprofitable levels. We're going to have a leg up this year to a higher level and probably a plateau at around 140, 150 average, $1.40, $1.50 average deboned meat, breast meat price wholesale going forward. Wing prices are my favorite prices because they act just like the economics textbook says they should. The demand is inelastic. When we restrict the supply on wings, the price jumps up, and you can see what happened in 2011 in the red line as production started dropping on chickens, and there's 2 wings on every chicken. Those wing prices started rebounding, and they'll be at a significantly higher level this year. Very popular product, reacts very quickly to reduction in supply. Let me just say a few words about turkeys. Remember, the chicken industry reduced production in 2009. The turkey industry also reduced production in 2009. But then the turkey industry, unlike the broiler industry, was skeptical and continued to reduce production in 2010 and 2011, as they should have been. And now they're in a position with much better prices and able to increase production this year. So turkey consumption per capita has gone down, along with chicken, down a pound or 2. And but the interesting thing that's happened is that turkey boneless breast wholesale price, whereas previously it was just a little bit more expensive than chicken boneless breast, became twice as expensive as chicken boneless breast in 2010 and 2011. Now, I think that's a temporary phenomena. It's not that much more expensive to produce turkey boneless breast. So I think what's going to be happening in the future is that the turkey boneless breast will be falling and the chicken boneless breast will be rising, and those 2 prices will come closer to each other in the future. So, in conclusion, the recession cut the demand for all meats, including chicken, which was a surprise. The industry overshot, the supply industry overshot the demand, but I think we're seeing slowly improving economy, and lower input costs are probably be coming along. So chicken profitability should return in 2012 along with higher prices. Thank you. Back to you, Gary.
Okay, thank you very much, Paul. Great information. Our next presenter is Dr. Christopher Hurch. Dr. Hurch joined the Purdue University Department of Agricultural Economics in 1981. He teaches an undergraduate course in livestock and meat marketing. Dr. Hurch's areas of specialty include examination of family farm market problems, pricing strategies, livestock futures market performance. In addition to his extension work, he provides analysis for participation in government programs, evaluates the livestock industry structure, and provides price analysis and outlook of live cattle and live hogs. Recently, he examined the factors influencing the structural changes in the pork industry and evaluated the adoption of new technologies in moderate-sized Midwestern farms. Dr. Hurch, I'll turn the call over to you at this point.
Well, thank you very much, and pleasure to visit with everyone here today. What I want to look at is follow up on several things you have already heard, and that is a lot of adjustments going on in the animals industry. And I think we have to recognize the big adjustments really have been to feed prices, the dramatic increase in ethanol use, as Tim suggested, and the second really big component of that has been almost an equal-sized growth in terms of the soybean exports from the United States going to China. Now again, that's the Chinese buying soybeans has been a dominant factor for South America as well. But those are the really big demand drivers that have pushed up feed prices dramatically. And so we know that feed is a critical component, generally the largest single component in raising animals, so obviously there has to be adjustment. And there has been adjustment. What we recognize from our economics is that the animal industries cannot immediately pass on corn prices, as an example, going from $2 to $4 to $6 and of course as high as $8 a bushel. They simply cannot do that. And so in the short run, in those first few months and first few years, they have to absorb the higher cost of feed in compression of their margins. And of course, that's known as losses in the business. That particularly was 2008, 2009, and those problems were complicated, as you've already heard, by worldwide recession and pretty deep recession in the U.S. and other major developed countries. So let's look at how the livestock has adjusted and include certainly the animal sector as well. We look at this last 2 years of the low feed price over on the right-hand side here, and that is, of course, 2006 and 2007. So per capita consumption of our primary meats, that's beef and pork on the red meat side, chicken and turkey, reached 222.3 pounds in the low price feed area. What has happened since that time? We see from the 223, the last of the moderate or low price feed, the reduction in 2012 to 199 pounds of per capita consumption for the United States. So this massive reduction actually is a result of the industries and the animal industries losing lots of money, and when they've lost a lot of money, they have reduced the size of their production and per capita supplies, and prices of our animal products have gone up. We'll illustrate that here by taking 2006 and 2007 as a base and look at per capita supplies in the United States of these four main meat products and call that 100. And so what we see since 2006, 2007, going to 8, 9, 10, 11, and now 12, as we look at turkey, we'll see turkey per capita supplies down about 5%. Then we have broilers, chicken, and pork down around 7% lower than the 2006-2007 base. And of course, beef is the one that really has had a very, very large adjustment, down 17%. Now the point of these adjustments is you can see that, as has already been mentioned, there were some different reactions. Timing is different, but we know that the broiler and turkey sector can adjust more quickly. We know that the beef sector takes longer to get that adjustment started, and once it gets started, we've seen a lot of carry through to the downside. Now, the other point on the right-hand side here is to look at the prices. These would be wholesale or farm-level prices of these products. As the supplies over here on the left, per capita supplies come down, that has resulted in higher and higher prices. So this is the natural adjustment that we see in our sort of our economic thought for industries. The animal industries cannot pass along these higher feed costs. They have to have compressed margins. They have to have losses. They have to then see their industry go through a period of decline in terms of supplies and bankruptcies. And as that aggregate or national supply and international supply comes down more and more, we push prices up to where they're profitable and we can pass on those higher feed costs to our consumers. Some other things that haven't really been talked about enough and relate very heavily, of course, not only to feed supplies, but also to forage and pasture supplies. So when we really start to talk about beef, we really become aware of how important particularly the Southern Plains drought has been to the cattle industry. As we look at Texas, certainly the focus of that drought. The U.S. Drought Monitor here is updated every Thursday, so if you're not familiar with that, that would be an excellent thing to put in your repertoire if you're thinking about feed prices over this next year. Now, we're not just that Southern Plains drought, but now have the southeastern United States into that drought and bringing most of the western states into the drought. And of course, this area that would be very much concerned about corn and soybean production in 2012, the upper Midwest. So the yellow at this point is just abnormally dry. The light brown is stage 1 drought, and stage 2 drought would be slightly browner. So this is going to be something that we really do have to watch very carefully. And again, as Tim suggested, I think all those thoughts say if we could return to normal yields on corn, soybeans in the United States, then we are going to see lower prices for the 12 crop. And I think those will be at least 50, 60 cents lower on the 12 crop than we see on the 11 crop of corn. And I think some moderate reduction in soybean meal prices. But the point is, this is very important to watch. If that jeopardizes our 2012 crop, we certainly can sail back off into the stratosphere in terms of prices. Now this has resulted in, especially the Southern Plains drought, a lot of liquidation of cattle. And when you look at this much dry country in some very prime cow-calf areas, the Southern Plains, the southeastern United States, now getting out into the California and the mountain states, that says we just are probably going to continue to liquidate cows going forward. The rain patterns have actually given a little relief. This is the last 60 days. The purple is at least 150% of normal precipitation over the last 60 days. And we see this area of relief certainly for parts of New Mexico and Texas and on over a little bit into the central, more Dallas-Fort Worth side, and continuing up into the eastern Corn Belt. On the other hand, you kind of see this dividing line here in the United States with the real dryness really developing into the western Corn Belt, the upper Great Plains, and certainly all of the West. So perhaps this Texas drought is getting relieved just a little bit, at least some areas. That purple area over the last 60 days has some relief. But again, this is going to have to be watched very, very carefully for our livestock sector and what it implies for both feed supplies as well as continued cow liquidation. This is the NOAA's forecast for what that drought is going to do through March of this year. The brown is that the drought will persist or continue. The yellow areas are that those areas are now going to be added to the drought. And there is a striped green area that says some improvement. So I think at least what the weather people are looking at going forward is that this is not going to be relieved. We're going to continue with some pretty grave concerns about not only pasture and forage production for our cattle industry, but this area we're going to have to really watch that very closely with regard to grain and oilseed production. For the export side of the business for livestock has been very strong. This kind of pinkish purplish line is the percent of pork that is now being exported. That's percent of U.S. production. So in 2011 and projected for 12, around 22% of production in the United States will move into the export market. Now, those of you in the poultry industry, certainly the broilers is this red line, around 19%, and again, that's held pretty steady overall as a percent of domestic production for the last 3 or 4 years. But we look at the beef sector, and here that's the green line, the big drop. That was the BSE cow discovery, and where most of the world just shut off buying U.S. beef. And we can see we have seen a slow but very steady recovery, now getting back to around 11%, which will be a record export of beef from the United States. Just for contrast, this black line is the amount of corn production that we export from the United States. We're known as one of the primary suppliers of corn to the world, and you can see as a percent of production that has been declining over time, and especially in more recent years as our government policy has supported using increasing amounts of corn for fuel rather than food, down now to 15% of our production that we export. That means we have 2 livestock species, both the pork as well as the broilers, where we are actually exporting more of that percentage of production than we see for corn. But demand for the meats, particularly the livestock, looks very strong in this coming year. As we look at the prices these are finished cattle prices, choice steer prices, we have a couple of things to kind of look at. This is the amount of beef available in the United States on the red line. It's scaled over here on the right. When we had $2 corn, $2.50 corn, we were producing about 65 pounds of beef per capita. Prices of feed went up substantially. We had the recession, of course, in late 08 and 2009. But you see that big transition to much less production of beef, and now we'll be down around 54 pounds this year. So as we had $2 corn, we could raise cattle for 85, 87, low 90s. There's the terrible recession year, really devastating for the red meats as well as poultry. But as we've gotten supplies down, 2010 record high cattle prices, new records in 2011, and new records in 12, and we think we'll see new record prices, high prices on finished cattle in 2013 and 2014. And I think the important point here for you in the poultry industry is that the competition is just simply not going to be real strong for that consumer dollar from the red meat side. And that's particularly related to beef. Those beef numbers are going to continue to drop. Brood cow numbers are going to continue to drop, it looks like, through this year. That means it probably will be 2013, early in the year, a year from now, before we begin to expand the cow herd, and then it's at least 2.5 to 3 years beyond that before we can get more beef back in the marketplace. As we look at calf prices, a similar kind of thing. Now we're pushing up to, these are 6 to 650 pound calves. We're going to be about $1.50 a pound this year. We think we're moving on up to $1.70, maybe $1.80 a pound over the next couple of years. By far, record high prices. As we look at the hog sector, back here in 2006, quarterly data, the bar is the price of hogs on a per hundredweight. The pinkish line is the cost. So $2 corn, we could raise hogs in the 40s or 50s, but now we have cost of production that are more like into the 60s or 70s it's going to take to cover cost of production when you push corn to $6 to $7 a bushel. So as we look at where we're at right now, we look at a little profitability for the hog sector, $62 versus a cost of about $60. In the second and third quarters, some pretty good profitability. And then by the fourth quarter, roughly a break-even time period. This says we are making some money in the hog industry. That goes back to the second quarter of 2011. And then we are looking at, if the normal crop comes in, as Tim suggested, we are looking at a lower corn prices, somewhat lower meal prices, and being able then to get this cost of production back down some if that crop comes in the United States in 2012. For 2012, the last 4 digits over here, this is the break-even cost for, I use this on the hog production, and we're at about $6.80 for this year. In other words, if corn doesn't go back above around $6.75 to $7, the pork industry can make some money. The point of all that is to say that we have gotten our animal industries adjusted in terms of reduced supply, where we can now operate with profitability with $6 corn or maybe even $6.50 corn. I think in general that's true across the animal sector. Well, let me close there and turn it back over for any questions.
Thank you, Dr. Hurt. We appreciate that update. And now we're open now for questions from the audience. Just a reminder, if you have questions for the presenters, please type them in the chat box on the left of your screen. We do have some questions, and I'll start them off now. And actually, we'll open it up to any of the presenters at this point to answer. The first question is, what factors are necessary for a better corn yield for the 2012 corn crop?
Gary, this is Tim Brusnahan. Traditionally, what we've seen is if U.S. farmers can get a good start somewhere in the last week of April, then traditionally we do have a better probability of a good crop. Last week of April, first week of May is ideally the prime window to try and get at least up to 40–45% of the U.S. corn crop planted. Now, not obviously everyone can do so, but if that can happen, then we can be on our way. And obviously, some good rains and weather we'll take it from there.
Yeah, this is Chris Hurt, and let me just throw out another perspective that Tim got us started on, and that is that we not only have to look at the supply side, but we have to look at the demand side on corn. And from the years 2005 to 2010, the corn crops 05 to 2010, because of ethanol policy, we were increasing the usage of corn just for ethanol over 500 million bushels per year for on average across those years. Now, the renewable fuels standard slows down substantially. It was Congress wanted us to ramp up quickly to get a lot of ethanol produced. That took a massive expansion on the demand side of corn. We're now in a period 2011 to the 2014 crop where that rate of demand growth for ethanol is only roughly 100 million bushels of corn per year. So where we sort of hit what we call that inflection point. We were increasing at an increasing rate, but now we're still increasing demand for ethanol a little bit, but at a much slower rate. That's going to give supply, as Tim's talking about, a much better chance to catch up in these next couple of years.
Well, talking about ethanol, we have a question. Is there any impact of the loss of the subsidy to the ethanol industry?
This is Tim. I'll take part of that or provide part of that answer. You know, it's a much bigger macro issue that maybe Chris might want to comment on. But as long as the U.S. Consumer and demand for gasoline remains strong or stable, then there's demand for ethanol. You know, if somehow for some reason our economic conditions worsen, then chances are demand for gasoline will decline, and then the demand for ethanol will go in the same direction. So if the worst is behind us, at least for the next year anyway, the ethanol industry should remain in a positive margin environment.
Yeah, I think I'd agree. Again, we just add that $100 oil says that gasoline is very valuable. That makes ethanol valuable. And the second important component right now is exports have been very strong on ethanol. That may not continue into the future, but for right now, we actually have very strong demand, and that keeps margins pretty strong for ethanol going forward.
We have a question about chicken tenders. The question is, chicken tenders have risen significantly over the past 2 months. Will that trend continue over the year?
Yeah, this is Paul. I think we can expect that to continue and prices to increase in all of the components of poultry, the leg quarters, the breast, the tenders, the wings especially. As long as that supply continues to decrease and the economy looks like it's going to improve, I think we can expect rising prices throughout the year.
Here's a question. What is the outlook for the U.S. dollar's value and the impact on U.S. exports of meat or grains globally?
Chris Hurch, to the extent Europe continues to have debt issues, I think this overall strengthens the dollar and weakens our export prospects somewhat. It probably is very important, but the dollar is a little hard to identify a direction, but I guess I'm going to be on the side of saying that we'll see some strength because of the weakening euro.
This is Paul. For the chicken industry, of course, the value of the Brazilian real is the important one. The real was quite strong a year ago. It weakened a little bit, but Brazil is generally less competitive than it used to be because the real over the last few years has been strong versus the dollar. So if the dollar strengthened a little bit, we'd still be in a good position with Brazil.
What is the estimated cattle herd reduction due to the drought in Texas, and how does that impact the overall U.S. herd?
Well, we continue to see 1 to 2% annual decrease in the brood cow numbers. And again, Texas is our #1 cow state. I haven't looked specifically just at those numbers in Texas, but that's a broader area. That's Oklahoma, parts of Kansas, and New Mexico, where we've seen that really drouthy conditions. And our drought map, suggests that you could bring California, Florida, and much of the southeast into that drought. If those pastures are short, we'll continue to liquidate cows all through this year. So weather, rainfall is going to be really important to if we can bottom out this cow herd in the United States.
Okay. There's a questioner who says, we have heard that there's a shortage of turkey eggs in the U.S. Do your numbers show the same?
This is Paul. I don't follow the turkey industry as closely. Usually, if there's a shortage of eggs, that means that the industry is expanding, as the USDA is predicting for this year. So that would be logical to get a shortage just before a period of expansion.
Well, here's a little bit different kind of question. What impact will foreign companies' purchases of poultry companies in the United States have? What impact will that create?
This is Paul. That's a very good question. Of course, we have Pilgrim now owned by a large Brazilian company. I think what it means is that we're becoming, at least the chicken industry is becoming, beef industry probably as well, is becoming a globalized industry, like the automobiles, where a company can be located in one country and produce in several different countries. So I think it's just part of the whole globalization trend, which has now come to the poultry industry, and it came during this period of economic distress.
Okay. What would you expect the red meat processors to focus on to increase consumption of beef in the sub-utilized cuts, underutilized cuts?
Well, Chris Hurch, I guess I'm not going to be able to be real helpful there. I don't work very closely at that particular level. Certainly the supply of beef is just going to be extremely tight. This means it's going to be a premium product above $5 a pound in the grocery store in the next few years, and so you know, I don't know what those packers and processors are going to be working on. So, but it's really going to be a premium product.
Will ethanol plants reduce the oil content in DDGs?
This is Tim. You know, this is actually a very new development that's only kind of been made public in the last few weeks. Right now, there's not strong evidence of exactly what percent the ethanol industry will make this switch. I would say maybe in 2 or 3 months we'll have a better idea. Right now, we have to believe that it's really more 2 or 3 of the majors that are making this adjustment. It's a new feed, and you know, there's a lot. I think we're at a point where we don't know enough about this new type of feed, and maybe Chris wants to make some comments.
No, I think that's right. Again, as the ethanol industry matures, remember the first thing that a lot of those plants just tried to get them built, those were dry plants. They used the starch in the corn to ferment the corn starch to make ethanol, so that left all the rest of the seed coat and all of the corn oil, and that's the dried distillers grains. Now the ethanol plants, as it matures more, they're trying to find ways to extract more of the oil. Corn oil is a very high value product, and to enhance their margins at the plant. So I think this will be ongoing.
Well, thank you very much, gentlemen. There are more questions. Perhaps the audience members will email you with their additional questions. We'll wrap our presentations up at this point. I want to thank you all three for a very excellent set of presentations, very informative. We appreciate it very much. I want to also remind our listeners that there are other webinars in the pipeline from wattagnet.com. In February, there is a food safety and the poultry industry webinar sponsored. That is February the 28th. March the 6th, there's the Poultry Outlook on the international front that's planned. And in April, a market volatility, exchange rates in the poultry industry business webinar. So please visit wattagnet.com and check the area of upcoming webinars. Gentlemen, thank you very much. Thank you, audience. We appreciate it very much. Good day.